Hello. If you search, you can find thousands of strategies using every possible combination of indicator and every possible combination of settings for those indicators. It's easy to think that more indicators are good because it gives you more confirmation of a trend and that there is some magic setting combination that will give you traders Xanadu. But it's more likely to just lead to confusion. I'm going to show you a simple strategy using a simple but forgotten indicator that you can tailor to your own trading style. When you trade, you're really trying to predict two things: which direction is the price moving and how far will it go. If you have a technique that lets you accurately predict the highs and lows, then good luck to you. But that is almost impossible to do consistently, and I prefer to wait until the trend confirms and take a piece out of the middle of the price movement. The indicator I use for this is perhaps not forgotten, but certainly not often used, and it's an indicator that you already have. This is the linear regression indicator, and it's great at showing you the trend direction and if the trend is strengthening and weakening, and can even help with understanding how far the price might move. If you aren't familiar with linear regression, I'll give a brief description. If you're already familiar with it, then there'll be a timestamp on the screen and you can skip forward to the discussion on the strategy. Linear regression is sometimes referred to as the line of best fit. That's not entirely accurate because best fit isn't well defined. A more accurate description is that it's the line that minimizes the sum of the squares of the difference from the points to the line. That probably didn't help. Maybe a diagram will. On screen I have a table showing the closing prices over a week. I took this from the pound-dollar chart recently. I can add a chart to this to show how the prices are scattered. You might get some idea of the trend direction from this scatter chart, but it isn't easy and obvious. Now I can add the points from the linear regression calculation and show the straight line through those points, and the trend becomes much clearer. Now if I just make the points larger so they're easier to see, and then I draw bars showing the gap between the closing prices and the linear regression points, this is how linear regression seeks to find the trend line. It's the line that minimizes the sum of the squares of these vertical bars. There's only one line through the chart that minimizes the variance in this way. I can't change the slope of this line or move the line up or down the chart without moving away from that minimum total value. Linear regression is already included in both Metatrader 4 and Metatrader 5, but you find it in slightly different places. On Metatrader 4, go to Insert Channels, and on Metatrader 5 go to Insert Objects Channels. There are two channels that will draw a linear regression: the standard deviation channel and the linear regression channel. I'm going to use the standard deviation channel and I'll explain the difference soon. To add the linear regression channel, just click on the chart at the beginning bar and drag to the end bar for the channel. You don't need to worry about where the price is for the starting point or the ending point on the channel. That's calculated automatically. Just the starting and closing bar. To adjust the linear regression or the standard deviation channel, first, if you don't see handles on the channel, either double click the middle line to bring up these handles, or you can right click on the chart, select Objects List, and then select the channel. Once you have those handles, dragging the handle at either end will extend or reduce the size of the regression channel. Dragging the handle in the middle will move the channel, keeping it the same length. And that's a great way to see how the slope is changing over time. As you can see, as I move this from bar to bar, the slope is going up and down with the trends. Now, the difference between the standard deviation channel, which I've drawn here, and the linear regression channel, they both use the same linear regression central line, but the standard deviation channel draws these upper and lower boundaries one standard deviation away from the line. The linear regression channel calculates the maximum distance from this line to the closing price of any of the bars included. So if I insert the linear regression line in the same bars, can see the outsides of the linear regression line are further away because this closing price is the maximum distance away from the central linear regression line. Now I'm using the standard deviation channel in my strategy because it's a better approximation of possible price movement than the maximum that's shown in the linear regression channel. Now to the strategy rules. Firstly, always confirm the trend direction with the higher time frames. I'm trading this strategy on the 4-hour chart, so I confirm the trend with the daily and weekly charts. Only trade if all three of the charts show the same trend direction. I use different periods for the regression analysis on each time frame. I'm choosing periods that make some sense to identify a trend in that time frame. So on the 4-hour chart, I use 18 periods, which is 3 days. On the daily chart, I use 10 periods, 2 weeks. And on the weekly chart, I use 5 weeks. Not exactly a month, but it's enough to make sure I have one complete reporting cycle and it deals with months that are slightly longer than others. When I draw the regression channels, I also stop at the most recently closed bar. Wait until a candle has touched the outside of the channel opposite to the trend direction. This is to get the trend pullback. So if the trend is downward, wait until the price touches the upper channel, and if the trend is upward, wait until the price touches the lower channel. At this point, check to see if the pullback might be a sign of the trend weakening. You can do this by comparing the slope of the regression in previous bars to see if it's holding or tending to flatten out. Set the entry point at the end value of the regression channel. Set the stop loss at the edge of the channel opposite of the trend and the take profit at the edge of the channel in the direction of the trend. And that gives you a 1-to-1 profit-loss ratio. Avoid news events because they tend to cause spikes. The spikes could go with you or against you, but I find that when news causes a spike against the trend, the spikes tend to be larger, and so they're more likely to take out your stop loss. Watch the size of the channel. A recent spike or a fast move can make the channel unusually wide and not a good indicator of how far the price may be moving in the future. The recent spike can also influence the slope, making the trend look stronger than it actually is. Also, review the slope of the line. If the slope is too steep, then the trend may not be sustainable, and if the trend is too shallow, then it may mean that the trend is about to reverse. Scene 17, trend strength. So, linear regression is a good indicator of the trend direction, but the slope of the line is also a good indicator of the strength of that trend. We just switch to a different chart. Now I've just added another indicator to show the history of the linear regression slope. It's a little like a MACD showing in a separate window at the bottom of the screen. This is a useful indicator to visualize the change in the trend, and I've included a download link in the description, but you can do the similar analysis without the indicator. First, by dragging the channel along the chart, as we showed earlier, you can see if the slope is increasing, decreasing, moving up and down. And that's what the histogram here shows. So you can do the same thing just by moving the channel. So if the line is becoming steeper, that's an indication of a possible strengthening of the trend. And if the line is becoming shallower, as it did here, that's a possible indication that the trend is about to reverse. Also, think about the slope of the line. Don't rely on just viewing the slope, because charts will scale according to the maximum size needed to show the bars on the chart. So in a time period where there's very little price movement, a line may appear steep where it actually isn't. An easy way to confirm the slope is first to decide the range of slope where you will trade in points per bar. So let's say you want to trade only if the slope is from 2 points per bar up to 5 points per bar. Then just multiply that by the length of your channel. So if you have a channel over 10 bars, then that range would be 20 to 50 points. I'll just shorten this to be 10 bars so that we can show it as part of the example. Now, all you have to do is measure the distance between the two ends of the channel to see if that is more or less, or if it's inside your range. And you can do that with the crosshair tool, like so. Or if you just grab the handle at one end and begin to move, you can see that the numbers appear beside that handle showing in this case that it's 10 bars long and for a vertical distance of 548 points. What I've given you here is the basis of a simple and easy to follow strategy, and you should use this as the basis of forming your own strategy. In the description I have links to download the linear regression slope indicator and the chart synchronization indicator that I used here. If you have any questions, please leave comments. If you found this video useful, please leave a like. And if you'd like to see more videos like this, remember to click subscribe and the bell icon to be notified when we post more videos. Thank you for watching.